Hey there, fellow investors and wealth builders. Are you ready to decode the labyrinth of investing? Today we're going to explore the top 15 ways to find a gold mine of a company that you should invest in. But remember, this is not financial advice and you should always do your homework before jumping into the market. We start with point number 1, the rock-solid fundamentals. Always take a good, hard look at the company's financial strength. Are they raking in profits consistently? How's their cash flow looking? Are they good at turning their resources into profits? These are all part of what we call fundamentals. Companies that ace this test are typically your safest bet for long-term investment. Alright, moving to the second point, the biggie sustainable competitive advantage. Look for companies that have a protective shield around them, something that makes them unique and hard to compete against. It could be a super cool patent, a brand that's loved by millions, a cost advantage that competitors can't match, or a network effect that keeps growing. Companies like these are the champs. They stay ahead in the race and often generate significant profits over time. Now comes number 3, management quality. Who's driving the company? What's their track record? How do they treat their shareholders? Good leaders are like the secret sauce to a company's success. Their decisions can make a huge difference, from steering the company through rough weather to hitting those growth targets. On to number 4, industry outlook. You want to place your bets on companies that are operating in industries which are growing. Sectors with a bright future offer better growth opportunities and higher returns. For example, think about how companies in clean energy, AI, and biotech are booming right now. The fifth point to consider is the company's debt levels. Too much debt can be like a ticking time bomb. High debt levels might mean the company struggles to generate consistent profits, especially if the economy hits a rough patch. So, always check their debt levels before investing. Next up, we're at point number 6, valuation. You need to figure out whether the company is undervalued or overvalued. You might just find a diamond in the rough if you find a company that's undervalued by the market. We're halfway there, on to point 7, dividend history. Companies that consistently pay dividends are often financially fit. They can provide a steady income stream and are generally a lower risk option for investors. It's like having a money tree that keeps dropping cash. Moving on to number 8, revenue and earnings consistency. Companies that have steady and consistent revenue and earnings growth are usually more stable and reliable. They're like the tortoise in the race, slow and steady often wins the race. Here we are at point number 9, the price to earnings ratio. This handy ratio can help you figure out if a company is overvalued or undervalued. Typically, a lower P/E ratio might suggest that the company is undervalued, and that could be a signal to buy. Rolling to point number 10, market position. Companies that have a solid foothold in their market or a significant market share are usually a good bet. These companies have the power to keep competitors at bay and maintain their profitability. Alright, number 11, future growth prospects. What's the company's game plan for the future? Companies with aggressive growth plans and expansion strategies are likely to offer better returns down the line. On to point number 12, the product or service quality. A company offering high-quality products or services often has a loyal customer base and a steady flow of repeat business. This can contribute massively to the company's success. We're nearing the end, and at number 13, we've got customer satisfaction. Companies that keep their customers happy tend to perform better in the market. Think about it, would you keep going back to a company that you had a terrible experience with? Probably not. Moving to number 14, financial ratios. These ratios like current ratio, debt to equity ratio, and others are like the health checkup report of the company. They give you a clear picture of the company's financial health. And finally, at number 15, we have the regulatory environment. Companies operating in a favorable regulatory environment can have a significant advantage. So, it's essential to understand the impact of regulations on the company's business. And there you have it, guys. 15 ways to identify a fantastic company to invest in. Remember, investing is part art, part science. So, make sure you do your due diligence and stay informed. If you found this video helpful, smash that like button and share it with your friends. And don't forget to subscribe for more investing wisdom. Until next time, keep growing your wealth.